Hello, everyone, and welcome to an episode of the Dairy Signal. We're glad to have you here for another great, I would say entertaining, but I know it's a full day here with Ben Buckner, who we are very blessed and very lucky to have not only as a friend, but a frequent flyer here on the Dairy Signal. So if you're tuning in for the first time or you're a seasoned pro, you know to ask your questions, lean into the discussion, and really hone in as we go through all things markets. What's going on, what's current, what's trending, where are they projected to go? So definitely lean in and own and hone in on that discussion. So if you are new and this is a new face to you, we have Ben Buckner, who is the Chief Grains and Dairy Analyst with Ag Resource Company. So Ben, I don't want to waste any of the time because there's a lot going on, always is in this space. So without further ado, I could fluff your feathers and give you all sorts of fun facts, but you have a lot going on, a lot of new news for us. So I'll turn it over to you.
Yeah, thank you so much, Kathy. Yeah, and as usual, we've got too much to get through, but we will do the best that we can to do that. And I think the updated summer, maybe early autumn outlook is not much changed. I mean, I think it's hard for us to really buy into the bear outlook for dairy market in the U.S. or even in the world, and we're still seeing world markets, move higher every 2 weeks. Every dairy signal we do, there's a new high price in the European butter market or the European cheddar market. So I think that's kind of the guiding light at the beginning and end. I think what has changed though in the last 2 weeks is we're getting a little more pessimistic on what the feed markets have to do to clear excess inventory. So I think that is what is unique to this dairy signal, and we'll touch on why that is. So if you are a row crop producer or you've got surplus feed to sell, we want to be pretty clear in communicating, recoveries at this point to give you those opportunities. Or the next chance we get might not be until seasonally positive trends kick back in, spring 2026. And it's pretty, and that even that argument's also pretty simple. Weather has been pretty good or really good almost every producing country on Earth. And so this probably might be the first year in 10 that we're going to see meaningful major crop productivity growth. And again, that's been something that's been absent from the market the last decade, but I do think it comes back in 2025. So the high level themes that we have are still generally the same. And we are fairly optimistic on protein markets, and that includes beef, fat as well. So dairy, beef, if you're a cattle rancher of any kind or cattle caretaker, I think the future looks pretty good. We have not seen any evidence that we are expanding the beef cow herd at all, and certainly not meaningfully. Maybe there's some measure of heifer retention ongoing currently. But to get back to pre 2020 levels, that's going to be a multi-year process. And in fact, we think the calf crop, for example, is getting smaller and smaller. Now, the beef markets will be incredibly volatile. Once you get a market that's at record prices and very tightly supplied, it doesn't take much. A 5% correction would be $12 a hundredweight, and you're still in a bull trend. We can also, at the strike of a pen, kind of open up the U.S.-Mexican border to feeder cattle trade, and that would change things pretty substantially. But we don't see that happening now. Even the things we do see in the beef markets are that we're kind of putting all our resources into still managing, early stages of managing screwworm. And so I don't think we're very close to opening the border. So again, demand for protein as well, kind of inelastic. We've seen no response from the consumer to record beef prices, rising chicken, rising pork prices. Protein markets as well. We'll kind of touch on butter disappearance. It's an all-time record high. I mean, there's something that's been happening the last 5 years or so with respect to the world's need or want for fat. That is ongoing. And the other part of this is, and I know we've seen a pretty steep, pretty rapid correction in the milk market, class threes and cheese specifically. But what we're concerned with, I think, is mostly margin. And those margins, if we look at least, milk feed ratios have gotten a little better this week. So I think that they probably expand even further over the next 90 or 100 days. So I think the margin is going to exist for the dairy producer. That's partially because we've got world weather issues to date, both hemispheres pretty much absent. I mean, we can kind of nitpick and look at some moisture deficits in part of the US, parts of Canada. Western Europe may have a harder time growing corn this year, but their wheat crop is going to be very, very big. So that's going to fill that gap. Brazil, probably a record, maybe a record by far corn crop. So again, we just have not had the supply dislocations that we have seen really every year since 2017. Those just aren't present currently. At the same time, if we look at feed markets, the next big demand driver is going to be to some extent, oil seed based biodiesel, but it's really Chinese demand. And we don't think there will be a deal struck between the US and China, at least through the remainder of summer. And that's not terribly insightful. Trade deals take a long time to get passed. Hundreds of pages of documents have to be signed. Everything has to be sorted out. And so, maybe we're 50-50 on a Chinese deal getting done ultimately, but, if it doesn't get done by harvest of 2025, we're going to be left with a lot of feed products to move. And it's going to be challenging to move those once we've got a lot of competition for importer demand. I do think kind of lingering in the background, this has been the case really maybe our 10th month talking about the US and world economy just limping along. I don't think there's a huge risk to any meaningful contraction in economic growth, but I don't think we're going to see the growth that we saw, prior to 2018 or so, fractions of a percent, maybe 1%. I do think food consumption globally will be as projected, a record high. So I think we're going to have to produce a lot of food because a lot of it is going to disappear. So I think that's the takeaway we've got for the economy.
Okay, so
There
then
are risks, though.
quick
Go ahead. Sorry,
question for
Cassie.
you, Ben. As we dive in and we think like, I don't want to ever hang our hat on one person. So when we look to China and wanting that deal, say that doesn't happen. We're left out there in limbo. Is there another partner, or would it be partners in that case that we would really, I don't want to say lean on or leverage, but really have to court a little bit more to have that export continue to go through and keep it viable?
Yeah, it would be a series of countries. It's very
Okay.
hard to replace China because they're the
Timeline.
largest importer of food products
Right.
and the second largest consumer, and also they're not very self-sufficient. So you think of a country like India, who is kind of the star performer economically at this point, in terms of population, but they're more sufficient in terms of a lot of things. Maybe dairy, maybe oils, vegetable oils, but otherwise they have been pretty active in paying the farmers to produce more of stuff. So that's, I think, the difference is
Sure.
import. The need for imports is really concentrated on China. Now, if you had a deal with India and really the entirety of Southeast Asia outside of China, that would be helpful. But I guess to your point, Cassie, we don't have any real details on any trade deals being done. So we're kind of left in limbo here.
Sure.
And so with that said, it's kind of back to basics. It's what is physical supply going to be in 100 days, and what do balance sheets look like? And this is kind of status quo from the grain analyst community. It's pretty fundamentally based, I think. And so,
Okay.
very good question, though. So, China is critical. If we're to talk about a new demand driver, it's got to be China. And that was the case in 2020 to 2023. And that's, as I'll show you, has gone away almost completely. So, do they come back is the big question.
Okay. Thank you.
So for the economy, I think there are some risks, and this has been the case for a couple of years. And this shows unemployment since the 1950s, 4.2% in May and April, pretty steady. That's pretty close to full employment. But I wanted to highlight some things, some theories about what happens when the trend starts to change. And so you kind of see here the accordion of unemployment rate over the last several decades. And when it starts to tick upwards, it usually stays that way. That becomes kind of the new trend. And I don't think that any of this is going to be very fast moving. Any potential meaningful recession or contraction in the U.S. economy is still probably, years away. But it has been pretty locked in that once you start to increase unemployment rate, it tends to increase further over the next couple of years. And there's been a lot of theories. Dr. Claudia Sahm has been made famous by anytime the unemployment rate rises by about a half of a basis point, foreshadowing something not ideal in terms of the economy. So this does linger in the background, but I think with respect to the current year's crop demand or food demand, milk demand, rest of 2025, what probably matters most is that everything seems to be humming along. Whether it's restaurant traffic, real disposable income is increasing, has increased at least as of April for a third consecutive month. And that sort of new records if we exclude COVID and government stimulus. So we do like to see this. Wages going up, unemployment still fairly low, consumer sentiment fluctuates, but I think spending is going to be unchanged, and spending on food will be higher, probably the highest it's ever been outside of the COVID year. So I think we're going to have to produce a lot of food, and all that food will be consumed. And this kind of spans the developed and the developing world. So we're not terribly concerned that there's going to be some major change in food consumption, at least for the remainder of 2025. And also, maybe one of the better proxies for kind of short-term economic issues is energy consumption. And so every week, the EIA gives us the gasoline that was consumed the prior week. And for the most part, it has been above year-ago levels. Certainly 3 of the last 5 weeks, we've consumed more gasoline this year than last year. In the week ending last Friday, gasoline consumption was 9.7 million barrels per day. That's an all-time record for that particular week, at least. So it does, again, seems like everything is going fairly okay when we think about the economy spending on things like energy and food. So I don't think the outlook's very doom and gloom just yet. Though we'll be watching unemployment rates pretty closely after the next couple of months. And so this is what we're left with. And I think we can track pretty easily the USDA's numbers. And the USDA does a pretty good job in tracking trade to come up with these numbers. And so these are, who knows exactly how many kernels of rice were consumed in the world last year or projected to be this year. But trade is fact. We know exactly how much of a commodity is put onto a boat. We know the name of that boat, where it's going, when it unloads. And so that's the starting point. And then you can kind of back into total consumption there. And so it looks to be a pretty routine year in 2025. So if we look at the markets that the USDA tracks that are kind of closer to the end use of food products, things like dairy, rice, meats, vegetable oils, they're forecasting 1.8 billion tons of consumption for these products. That is growth of 1.3% from last year. And that kind of mirrors the long-term average, which is 1.5%. And to that end, you don't really see meaningful corrections unless there's outright, recession, depression, or if you don't produce the stuff. So, thinking about something like 2012, crippling U.S. drought, corn demand was down because it did not exist. Otherwise, food consumption fairly inelastic, and we think that will be the case in 2025. So that's pretty good. And that's, again, kind of underscores or is the very base of this protein fat outlook that we've got. We're producing more, but is it enough to trigger oversupply or even kind of adequate stocks for a lasting period of time? Things like protein and fat, I think the answer is kind of no. We need more cows of all kinds, I think, for the next year. We just may not get them, at least in the medium term. But what does bother us, I think, is why we're tempering growth expectations for the U.S. economy, for the global economy, the Chinese economy especially, and even you can't project food use probably much better than 1% or maybe 1.3%. And that's sort of this ongoing battle between the U.S. and China. And I think that is the core of the sort of all fluctuating trade war, which I suppose is not terribly robust currently, but the first week of July, we will have to revisit those tariffs that we took off of the rest of the world. That 90-day reprieve, that runway is running pretty short at this point. But it's who has influence. And so it's clearly the U.S. against China. Everything else is just collateral damage. Does this get resolved? And it's kind of hard to say how it gets resolved or gets resolved in the short term. And kind of the underlying factors, two countries vying for trade, economic dominance. And that's, I think, going to be with us for a long period of time. And this is why. We've shown this before, but the share of value added to the manufacturing sector globally, China has 30% of that. The US and Europe have been, their share has been declining. So the US, Europe, most people want this back, or they want to have better footing when compared to China. And then, of course, the U.S. and China are the two by far largest economies on Earth. And so who will be the top 2 decades, 3 decades from now? I think that sort of underscores all the tension that we're seeing. No one else is even close. And so that explains why we do have political whims that move this way on both sides. So China wants to maintain or export manufacturing dominance. The U.S. wants to increase their share. It's just hard for us to say how all this gets resolved, but we do know that trade war is not terribly great for food consumption growth, lifting people out of poverty. So that's something that we're going to be concerned about. And again, why there will be still a lot of headline risk. And I think the next sort of benchmark will be about July 9th when does the Trump administration put back reciprocal tariffs on these countries, given we haven't seen or heard anything about a concrete trade deal to date? Or do we keep those at 10%? Do we keep the tariff on Chinese goods at 50%? Those are all questions that may have to be answered in the next couple of weeks. But I don't think the trade tension goes away anytime soon. China is also a concern for us for another reason. And, this kind of predates the trade war, but also the discrepancy, sort of the spread between the US GDP and Chinese GDP was getting wider prior to early 2025. China's kind of shooting themselves in the foot with population contraction, maybe unwise investment into real estate, which is now imploding in China. But these numbers are all getting worse. So China's got a lot of problems anyway, and that's, trade wars are not going to help one of the largest producers of things and also kind of a growing consumer of food products, imports from the US, agricultural imports. None of this is terribly optimistic, just given what China's already going through. And we've talked about this on the Dairy Signal before, but the IMF's latest report, twice a year, October and April, the April 2025 report made this population issue worse, the GDP issue worse. So in October, the idea from the IMF was that China was going to lose between 2024 and 2028 about 6 million more persons. Well, there are new updates between 2024 and 2028. Now they're projected to lose 13 million people. So this population contraction is seemingly getting worse. And so you kind of go through the whole very broad stroke, aging population, eating less food, fewer people eating food at all. And so none of this bodes very well to us for Chinese economic growth or food consumption growth on the margin. And so it may be harder to get a deal done if that's the case. If China doesn't need or needs less imported food products or grain, what's the incentive for China to move swiftly or easily in any trade deal? So again, China is kind of a thorn in the side, I think, of the ag market as a whole. And there has been at least 1 month of evidence that once tariffs do get prohibitive and the trade war reaches a peak, China does, to some extent, leave the U.S. market. And so we've seen them buy virtually no corn this year, buying a lot less soybeans. We haven't shipped soybeans to China at all in several weeks, which is in part seasonal, but I think the trade war did exacerbate or accelerate China's move to South America for their soybean supplies. And in the dairy space, we knew this was going to be a big risk. We didn't know exactly how to quantify it. Does China stay in the U.S. export market or not? And in April, at least, we did see a pretty sharp decline. So total dairy exports from the U.S. to China dropped to about 23,000 tons. That compares to 37,000 tons in March, and it's down sharply on last year. And what is a pretty sizable feed ingredient, U.S. whey specifically, dropped pretty heavily from 22,000, cut it in half to 11,000 tons between March and April. So this is not, I don't think, concerning. We're finding a lot of other markets in dairy, and dairy, I think, is the bright spot in the world of U.S. agricultural exports. But ideally, we would like Chinese demand growth from the U.S. And China is sort of the third largest customer of U.S. dairy products. So this is important when we're thinking on the margin, how does dairy supply and demand change? And I think we do have to contend with China leaving the US space if tariffs go back to 145%. I don't think they're going to abide by that. Long term, I don't know where China gets dairy products from, but this does show us that at least for 30, 45-day periods, they can look elsewhere, and that's going to be the case. And it just kind of underscores all the tension and all the concern with respect to this ongoing war between the US and China to be the dominant player in the economy. We talked about demand growth and the need for a Chinese trade deal, and a Chinese trade deal specifically, or many, many other trade deals with the rest of Southeast Asia to replace that. And this is pretty clear to us. So Chinese grain imports between 2020 and 2023 were 32 to 40 million tons. So we just isolate corn. That is similar in why corn went to $8 ultimately in that peak bull run. This is like the North Dakota and Ohio crops just disappearing from the market. That's hard to replace. But since then, China has been very, very inactive in grain imports. So the USDA's forecast for combined Chinese corn and wheat imports in the current crop year is just 11 million tons. So down, substantially from last year. And their forecast for the next crop year, 25-26, is 16 million tons, which will take any kind of growth, but this growth just isn't very meaningful. I also think that they've got to lower their current crop Chinese grain imports. So for all intents and purposes, China has not imported any corn. To date, has only shipped 1 million bushels from the United States. 2 years ago, it was about 1 billion bushels. And so for whatever reason, and I think this is kind of rooted in fundamentals, China is showing us that they don't need corn. 2 years ago, they of course, did not need U.S. corn, and that's when kind of this tension developed. But they imported a lot of corn from Brazil, and that's fine. This year, they've imported corn from no one. Now, on the right, you see just the spot hog price. It's been unchanged at about 13,500 yuan since January of 2025, and not terribly inflated, actually quite deflated. So we kind of put the puzzle together. It does not seem like there's any concern over meat supply availability in China. And so if that's the case, you don't need as much soybean to crush for meals. You don't need the whey. You don't need the corn. And so that China is not importing a lot of stuff, that's not making their domestic markets go up, is telling to us just the arithmetic seems to suggest that might be a challenge to get China to return to the ag market unless there is a major weather problem there. But as part of our feed market theory, there just hasn't been many weather problems anywhere, China included. So probably, as has been the case for the last couple of decades, China will produce, as far as we know, at least a record or near record corn crop this year, near record wheat crop as well. So I don't think China fundamentally needs the imports. And to that end, it's hard to separate what happened in 2020 with the phase one agreement that was very, very good for U.S. agriculture. But it also followed a pretty dire 2-year period of African swine fever. So we're not sure if it was maybe it just conveniently timed the phase one deal, but China did have to rebuild their hog herd, and so needed a lot of stuff and bought it from the United States, and everyone was happy. But it does not seem like there's a hog supply problem. And pork, of course, is the most consumed meat in China. So until the hog market starts to show signs of life, it's very hard for us to be terribly optimistic. China needs a lot of imported feed grain. So again, China is the thorn in the side, especially the grain markets. Dairy market themes similar to 2 weeks ago, 4 weeks ago. U.S. milk production is going very well. Expansion returns in earnest, and a lot of this is rooted in the swelling of the cow herd, and this is happening kind of despite what we're seeing in the beef and the beef cow markets. But and it's kind of isolated to certain states, but we have added a substantial number of cows to the milking herd, and that is offsetting what's been pretty disappointing yields, but we are producing a lot of milk in the United States. And the math would suggest that that probably stays in case until at least the middle of autumn. So unlike the last 2 or 3 years, I think the producer and the market's got to contend with pretty ample supplies of raw milk, at least in the medium term. Competing countries also alternate between growth and contraction. We did see some pretty or relatively big numbers out of New Zealand for the month of May. So it does seem like there's not a huge milk supply issue in the world, at least for the next month or 2 months. I think more than anything, though, that explains why Class 3 has done what it's done in the last 2 weeks. No supply issues. We know that similar to China leaving the U.S. Dairy space, the processors can kind of draw down on what they need or drop prices pretty significantly for short periods of time, and that's what happened. But we look at demand on the other side, and we can see that there is lingering in the background a need for record production. Total dairy disappearance has been a record large. Exports pretty incredible, and I think that stays that way for the foreseeable future. And like we usually do, we'll touch on where the U.S. markets exist relative to competing markets, and to be honest, it's very, very cheap and getting cheaper. So I don't think we're going to see any change in very, very large U.S. dairy exports to all destinations. And U.S. products, again, just outright cheap. So I think we're going to see kind of not even a seasonal drop in something like cheese export. So it's going to add to disappearance, going to help offset some of the milk that we're producing above and beyond last year. But
So
this
then,
is
Dan,
pretty clear.
sorry, Dan. So that back to the availability on the U.S. dairy product, is that both because we're domestically consuming it just at a larger rate? Is it also, or does it contribute because we have a weaker dollar? Like, what's helping drive that? I mean, this that cheapness.
Yeah, it's I think it's the milk production in the U.S. has expanded consistently and by a lot more than what we've seen in places like Australia and Europe, especially. So we've got the products, and I think that makes sense. I mean, the market gets together every day and determines the price, and I guess there's not any need yet for premium to be added. And I think in the background it is just production, and so we tend to peak, outright volumes of milk production in either March or May. This year, I think it was May. And then so seasonally, you start to lose milk production. That's just how this works. I think it's daylight hours, if nothing else. So in the last, 3 weeks, we have had the most milk we have had in a couple of years. And we have the most milk that we will have for the rest of 2025. So I don't think there's been a real need to really get up and go and match the world markets. But it's clear the world markets are struggling supply and demand. It's just the U.S. has adequate milk supplies today. I think that would explain that. And part of that is just the addition of cows in really Kansas, Texas, and South Dakota. So Texas and South Dakota, since December 31st, have added a combined 30,000 cows to the herd, which I think is important. Texas recovering fully from bird flu. Even California added in the last 4 months, 3,000 head. So I think bird flu has been managed in California as well. And Kansas up 19,000 the last 4 months. So again, it's all kind of explains the end of bird flu. I think some incentives in prices of milk prior to the last 30 days that there has been the incentive to expand. But this explains completely what we've seen in terms of U.S. milk production expansion over the last couple of months. And it's been pretty impressive. I think the question that we've got to ask ourselves now or think about is, normally if we go back, a couple of decades, of course we build cow numbers in the spring. Do we start to seasonally contract cow numbers, and to what degree will be the question. But for now, again, there's no issue for U.S. milk supplies. And in fact, the monthly numbers in April and May exceeded expectations by a couple tens of millions of pounds. So official U.S. production in May was 19.9 billion pounds, up 1.6 from last year. And so we finally got back to kind of pre-2021 levels of growth. This all looks pretty normal. Now, to be fair, we are comparing this year to last year, which was very, very deflated production. But I do think that the market has recovered. And if we just use sort of the current cow numbers, and even assuming, what's been a pretty deflated yield growth number, 0.2, 0.3% year over year, these are kind of locked into growing production through, June, July, and August of about 1.2 to 1.5%. So again, we also can see that milk production, of course, kind of follows changes in cheese production, follows changes in milk production. So we're probably going to expand cheese supplies over the next 3 to 4 months. That will provide some relief to the market. I think it's the sort of mid-autumn onward, we may see growth drop to 2.3%, but we think the USDA's annual forecast is about correct. So kind of meaningful growth, let's call it 1.2 billion pounds for the first time in 4 years. And I do think that's what we're locked in with. And we all got to think about this and contend with this. I don't think we're going to see $21 class 3 milk even during seasonal peaks in September, October. I do think there is upside in the dairy space. It's just what's different this year than last year is just the sheer amount of milk the U.S. has been able to produce on a national basis. And for now, New Zealand's kind of joined. Now, New Zealand and Australia, it's their winter, of course, so they don't produce much milk at all. So we're comparing very small numbers, but New Zealand has kind of limped along, managed growth of 8%, about 50,000 tons in May of 2025. And so the last really 10 months, only 1 month has been down year over year in New Zealand. So I think milk supply is today adequate. The U.S., of course, has more than anyone else just based on how fast and how much we're growing production. But what has been our guiding light, again, has been the global market. And that is why I say it's very hard for us to be bearish of fat and protein, dairy products as a whole at these prices. So the trend is pretty clear in the dairy space still. So we are not terribly far from all-time records in 2022. And so every 2 weeks, we have two data sets. One, we get updates on the physical cash markets and competing export markets in like Europe, Australia, New Zealand. Kind of the alternating every 2 weeks, we get the global dairy auction result, which is pretty heavily weighted towards, the Australia, New Zealand market. But I'd find benchmark and they tend to follow each other pretty closely. But as of last week, the dairy auction was up just a little bit. So up 3 cents a pound on all products traded. The weighted average price, it's $1.99 versus $1.96 in early June and versus $1.77 a year ago. So, as people get together, determine fair value on any given minute or day, people have, shed or extracted premium from the U.S. class 3 market, but, the same thing happening globally is very different, almost higher prices, the uptrend line still very much intact. And the physical markets, another 2 weeks has passed where we've got even higher Oceania European butter prices, steady to higher Oceania and European cheese prices. So butter in Europe last week traded at $3.90 per pound in the physical cash market. New Zealand traded at $3.70 per pound in the physical cash market. That is a new high in New Zealand, the world's largest exporter. U.S. Butters still fluctuating, $2.50, $2.55, which is fine. Again, I think we're building stocks still Again, the first half of the calendar year guaranteed to build inventories. That is just the seasonal evolution of supply and demand. So there's no need for the U.S. market to go to $3 today. But I think we can say at these ratio or these spreads, the U.S. is going to be a pretty sizable exporter, probably into the end of 2025. And that's different from where we were last year and the year before. I don't think you can be bearish of butter at $2.50 if the European market is close to $4 per pound. U.S. block cheddar last week physically traded at $1.95. Cheese in Europe is $2.40 and in New Zealand is $2.28. So again, nothing is ever indicates we have to go meet the world market, but I think it is still very difficult to be bearish of cheese at these prices. And also, we can stay at these discounts, but we are going to see pretty sizable exports, probably record cheese exports for the specific months, probably into September, October, when we get Oceania milk production coming back in full. So a lot of cheese will be made to disappear over the next 100 days. How much will we produce? What is the sort of trend in inventories is the next question. And they've been slow to build so far, and I think that continues. This is what this looks like, and we've kind of highlighted this before. The export data is very much in arrears. This is from the month of April, but all-time record for that month. Cheese exports 49,000 tons, barely below the all-time record ever scored in March of 2024. And of course, butter exports have gone from 3,000 tons a month to 8,500 to nearly 9,000 tons per month. But this is occurring as we look at the world cash market and the spreads between the different origins. I think it makes sense. So it's pretty clear to us that economic theory still works. If you're cheaper than someone else, more people will buy that stuff, and that's going to be the case again for the next 4 months. Because this tells us what happens through April. But the snapshot of the market today is those deficits, or the discounts in the U.S. are as wide or wider than they were in late winter and spring. So we're going to, again, cheese exports, butter exports are going to be pretty sizable. There's a pretty big switch in the butter market. And I do think that, from the big picture, the fat market probably does take over bullish leadership in the world space, but especially the U.S. dairy space. So a year ago, net imports of, we're adding 8 to 15 million pounds to supplies every month. Now, net exports are drawing 3 to 7 million pounds from supplies every month. So there's kind of a swing of up to, 22 million pounds in the monthly U.S. butter balance sheet. And I think that these bars stay above zero probably until September, October, if not further, just because we haven't seen really any relaxation in the global butter market for going on 3 years now. This is a long-term bull market, and the world's demand for fat, I think, is clearly outpacing what the world can produce. So I think this is a big deal, and this is really drawing upon stocks relative to expectations. The butter stocks have peaked. They tend to peak on May 31st. And so it's kind of the rate of that descent for the rest of the year is what's most important. And the dairy space, and we've kind of highlighted this before, feels as unnecessary or is very bad at assessing forward risk. So it's just kind of trading what was this week's production, what is disappearance this week or in the last 30 days. I still think we've got most of butter demand ahead of us. And so I still can't rule out, like we've seen the last couple of years, something close to $3 per pound in butter. Just because what you see in the month of June and July do not tend to foreshadow very well what you see September, October when you reach peak demand. And questions about currencies have come up, and that makes a lot of sense. So what we found is that in the U.S. ag space as a whole, this pretty substantial U.S. dollar weakness is not correlating with broad commodity indexes. It's not enticing investment into things like wheat or corn or soybeans. And so what's going on there? And the answer to us is that the dollar index, of course, is pretty heavily weighted to the euro, which you can see is at a multi-year high now. But currencies still in places like Australia and Brazil and Argentina have not strengthened all that much. So you're still seeing a lot of incentive to grow grain production in places like Brazil, Argentina, Ukraine, and Russia. But in the dairy space, we are very concerned about what happens in Europe. So I think this will exacerbate the funneling of import demand for something like cheese or butter to the US. I think our biggest competition for world cheese market share is Europe. by a wide degree. And even butter from Ireland is going to get a lot more expensive because of the euro, if nothing else. So I think this is a pillar of support to the dairy space, even if it's not a pillar of support to something like corn or wheat. It's just, are you concerned about Europe is the question. And in the case of corn, we are not, but in dairy, we very much are. So I think, again, the idea is, price discovery will do what it does on a daily basis, but exports of cheese will be very, very large, partially because Europe's not producing as much, and also the currencies are favoring U.S. exports even more than they were 2 and 3 months ago. Putting the entire piece of the puzzle together, we have got total cheese demand through April 30th, about unchanged from last year. I think it's down half of 1 million pounds. Still have pretty seasonally robust cheese disappearance really until October. So I think that, again, we're going to make a lot of this stuff disappear. Exports will help. But it's the fat market, the butter market, that's been so impressive. And it does not matter what the price of butter is. And it hasn't for about 3 years now. So butter consumption in the month of April was 210 million pounds. That's up 20% from the previous year. And we still have peak demand left to come. I mean, there is a scenario in that we are consuming 260 or 70 million pounds of butter per month in October and November. We're not going to be producing that much. So again, this the rate that inventories in butter drop is critical, but I think it will be pretty fast just given we've got growth in domestic use. There is no price that rations fat consumption. And also, again, just thinking about on the margin, adding 5 million pounds to disappearance in the export market rather than like a year ago adding 10 million pounds to supply. So I again think the collision of those things is pretty important. I think the butter market gets very tight.
Yeah,
As an aside, as we always do, the cash whey market clearly has bottomed like it normally does in April, non-fat dry as well. Every other month we fail to produce more than we consume, and so we have seen stocks pretty deflated relative to last year in the whey market. Not fat dry, just finding buying at current prices, and so I think we've got pretty clear uptrends until the end of the year in both those markets. So on balance, I think that helps the value of class 3 and class 4. Actually multi-year highs for the month of June in both whey and powder markets. So again, thinking about the fundamental or structural value of a volume of raw milk, I think it stays pretty high until you get to the very end of the year. So again, class 3 can behave erratically, but I think it is a little bit cheap, certainly below $17 spot, but we see fair value probably between 18 and 19.50, just given what we see in the export market and in the product markets as well. And so that was a very long-winded way of saying USDA is probably about right with its 2025 national average cash milk price forecast. Futures price action to date, maybe this is a little too high, but something over $21 a hundredweight in 2025 makes sense to us. Historically, pretty good price. And I think what we'll all be able to benefit is, still those beef crosses and a declining feed market. We've kind of talked about, cattle supplies, this ongoing bull market. And I think, generally speaking, the trend is still higher in beef and beef cow markets. We think June 1st, total feeder cattle supply is just, 13.8 million head. It's very, very small, multi-year low. But we kind of run some correlative studies. And so we've got the January inventory report, of course, in the rearview mirror. The July cattle inventory report is forthcoming. But just looking at what supplies were even on January, we can kind of back into what we think the calf crop is going to be in the middle of the year. And we think that, the spring calf crop, 23, maybe 24 million head. 7th consecutive decline and the lowest number since record keeping started in 2005. So kind of we back into an annual calf crop of 32, maybe 32.5 million head, and that's the smallest since 1941. So I think the on-feed numbers have at times shown signs of growth, but from a big picture structural standpoint, I don't think the beef cow herd is going to be getting much bigger in 2025. Maybe 2026 is the year. Maybe we do see some heifer retention and some on-feed reports in the next couple of months. But the beef market looks pretty supportive to us. But again, we want to highlight when you get a market like this, you must expect volatility. I think the biggest risk would be just, again, striking the pen, opening up the border, all of a sudden this backlog of cows that probably exist in Mexico find their way across the border, and we have at least some short, medium-term relief. But again, I think our recommendation is continue to expand the beef dairy crosses. I think that's going to be a fine revenue source at least for the rest of this calendar year, if not until something happens where we start to expand the U.S. beef herd, which may still be a year or two away. So the dairy market theme to us is kind of unchanged. I mean, world market's still very elevated. What kind of caps rallies is larger U.S. milk production, but protein fat markets, I think, perform pretty well for the rest of the year. But the feed market outlook has changed. And I think if there's anything to point to, it's now, the tail end of June. We can forecast start to peak into July 10th. Our kind of basic crop progress work would suggest the national U.S. corn crop will reach 50% pollinating on July 13th. So we're just about there in terms of forecast. Don't see any big heat, don't see any real lasting dryness. I think this could be a very, very big corn crop. So usually when you get to about this time, maybe the 4th of July holiday, the market gets comfortable with large supplies and starts shedding premium. Maybe we saw that a couple of weeks earlier this year. But I think the key, and it maybe come down to one thing, is that it rained quite a bit in northern Brazil between June 10th and June 20th, which is not something that really ever happens. And the importance of that is that the winter corn crop typically pollinates and fills grain without any water. And so the debate over how much corn Brazil produces, our largest competitor for world market share in corn, they were debating his yield 85 bushels an acre or 95 bushels an acre. But I think this year we're going to see what happens when a lot of that crop does have access to water during pollination and grain fill. Is it 105, 110 bushels an acre? All of a sudden, we're seeing a lot of competition for world corn market share, and competition is never bullish at price. We've also found what we've seen in June so far, and Wisconsin's been fairly wet. A lot of the western corn belt's been pretty wet, and of course, there's still surplus soil moisture in the eastern corn belt today. Favorable June or like normal June rainfall and temperatures often lead to continued non-threatening weather in July. So we kind of analyzed weather patterns going back to 1895, and it's just a bad June doesn't guarantee yield loss, but a favorable June does often foreshadow favorable July weather. So I don't think we're going to have the U.S. weather threat. But that said, because what's happening in Brazil, what happened in Argentina, we don't see any major problems in Europe or the United States, global major crop yield to expand for the first time in many, many years. And that's something the markets haven't had to contend with in a while. So we're thinking increasingly oversupplied feed markets, especially, let's say, between August and December. And so this, again, if you're producing, if you have surplus feed, you want to use recoveries to hedge risk. But if you're going to buy feed, I think doing it on a scale-in basis makes sense, but it is going to be a buyer's market for the foreseeable future. How low does corn, wheat, soy meal get, I think, is the next question that we'll debate as we get into the details of U.S. corn, soybean, and final wheat yields. So this is kind of what this looks like. So, as class 3 is broken, margins seemingly, at least, on paper, haven't really changed all that much. And I think that these ratios get even wider, at least between now and harvest lows, sometime between, August 20th and October 1st. So pick your spot. We do want to communicate that seasonal trends are bearish corn, bearish soybeans to a point, but then you do tend to find bottoms at some point. Again, as early as August 20th, but could be as late as October 15th. So the runway exists, but it is getting smaller every week that passes. But I do think that these ratios stay wide. I mean, I think that the margin for producing dairy and beef, especially, are going to be pretty robust in 2025, probably into 2026 as well. So this is what when I talk about what happened in Brazil. This is what we mean. So this shows us June 15th to June 24th rainfall. The winter corn belt is highlighted, and you can kind of see rainfall of 1.5 to 2.2 inches in a lot of places. You can see my cursor. This is Mato Grosso. Half of Brazil's winter corn crop is produced in this state, and we're hearing very, very big yields. A pretty reliable private forecaster just concluded a couple of crop tours, and again, you never want to take any private forecaster's number as gospel, but they have raised the total Brazilian corn crop in 2025 to 150 million tons, or about 5.5 billion bushels. And for context, the USDA is currently at 130 million tons. The estimate from this company, AgroConsult, was up 10 million tons in just 1 month. And so we can all debate whether they're correct or their track record, but certainly the Brazilian corn crop is getting larger. It's not getting smaller. If you see the seasonal rainfall pattern in Mato Grosso, Brazil, it's very rigid in nature. It's a tropical climate. It rains, 7 to 10 inches a month from November to March, and then, decreases, goes to zero during our summer. But the red bars you see in 2025 actually average about an inch to an inch and a half in both May and June. So again, this is unique to winter corn crop production. So I do think it will be a very big crop. Let us assume that the Brazilian corn crop is 140 million tons, not 150, but not 130. This does add about 8 million tons to export potential. And so that's competition we haven't really seen since 2022 when US corn exports were pretty deflated. Seasonally, Brazil just starts to get going and committing its corn crop to the export market. They won't finish this harvest until the very last part of July, but I do think that we're just getting started and seeing competition or competitive offers from Brazil. So, what has been the driver of the corn market and the feed market as a whole has been near record US corn exports. We had pretty bad Brazilian crop last year. We had a crippling drought in Ukraine, Eastern Europe. If you needed corn, you bought it from the US. The risk that we think is that that is starting to change. You can buy corn now from Brazil, Argentina, Ukraine, and Eastern Europe pretty easily. So that's what's different. And so that collides with a record US corn crop, most likely, which is very, very big supplies. The wheat crop, especially in the plains, but really kind of nationwide, avoided threats as well. Very highly rated crop. Will be a little late in harvesting. And since we are hearing yields in Kansas of 70 to 90 bushels an acre, protein, milling quality could be an issue. But for the feed market as a whole, we do think that the U.S. Winter wheat crop will be about 1.4 billion bushels. Hard red crop of about 780 to 790 million. If we assume even modest consumption growth, higher exports, higher feed use, you're still left with 500 million bushels of hard red winter wheat at the end of this crop year. That's a number we've only seen a couple of times in history, and stocks to use, I think, will be a record 77%. Over 200 days of consumption will be left over at the end of this year. So we're thinking about, record Brazilian corn crop, most likely a record corn crop in the U.S., and very, very large wheat supply availability, in those feed-heavy areas of the western U.S. plains. So who wins? Who wins the battle for feed? I do think there is a battle forthcoming. Already, you can buy hard red wheat in western Kansas 65 cents below the Board of Trade. It's not an expensive market. So I think this all kind of probably gets worse as you get into peak harvesting in the next 2 or 3 weeks. Meal and DDGs also most likely oversupplied. I think the meal markets, more actively has been reflecting this the last couple of weeks. And it comes down to one, we're already producing record amounts. There is competition for soybean meal exports from Argentina still, but it's the EPA's proposed biodiesel blending volumes. And this has been one of the highlights or the hot spots of the ag space the last couple of weeks. But finally got those out. A lot of rumors on both sides going both ways, but what has been proposed is a pretty substantial increase in biomass-based diesel. They're calculated in RINs, but someone's already done the work for us. The best guess is that the mandated volume of biomass-based diesel, so biodiesel, renewable diesel consumption in 2026 will be 5.6 billion gallons, as of about 2.2 billion from the current year. And so we're going to have to use a lot of soybean oil. And part of this, I think, and there's a lot to be sorted out. None of this is officially passed or been signed yet, but kind of restricting the use of imported diesel or biodiesel and feedstock. So it's going to have to be, come from either Canadian rapeseed, U.S. vegetable oils, going to have a higher share of biodiesel production. So we're going to be producing a lot of soybean oil. Crush margins have bounced. That is not because of mill prices. I think if there's any growth in the expansion of U.S. crush capacity, it's for this burgeoning bull demand story in soybean oil. What we'll be left with is even higher record U.S. soybean meal production on a monthly basis. And so how do you clear those inventories if there was not a supply problem or weather issue in Argentina, the world's largest meal exporter? So at some point, it's kind of a race to the bottom and getting rid of this stuff. So downside, I think, still does exist in the protein meal market because of U.S. biofuel policy. Last week, we break down weather, and this is what on the left looks like from June 1st to June 2025 in terms of percent of normal rainfall. And so not everywhere has been perfect. There are still some issues. Parts of Canada, North Dakota, western, eastern Iowa. But a lot of those issues even look to be solved. On the right, you see the NOAA's 5-day forecast, which we have a lot of confidence in, those 5-day forecasts. So more soaking rain. I don't think water availability will be an issue. And I know that there's a lot more to corn, soybean, and spring wheat yields than just water and temperatures, but I don't think those two things will be a primary issue. So again, having gone through the end of June, probably get into the first 5 or 10 days of July without any meaningful U.S. weather threat. And again, looking at climate data back to 1895, let's isolate years that June has been wetter than normal. And this is what comes out. Not guaranteed. 1983 was a very big year for price and drought because the spigot shut off completely in July. But on balance, if you look at probabilities, probably suggest a pretty routine July is forthcoming. Even when we look at corn yield, there are years when things have changed, but for the most part, you're kind of locked into something like trend, a little bit above trend corn yield. And so I think that's the next debate for the corn market is, it's done a lot of work extracting premium, but if you add 1% to trend yield in 2025, that is a yield of 183 bushels an acre. And relative to the USDA's forecast, it adds about 175 million bushels to production, which will be added to very sizable wheat supplies, meal supplies, cheap DDGs. Again, I think we're kind of getting to the point where the feed markets will be certainly amply supplied, if not oversupplied, come this autumn. And kind of lo and behold, this is the best guess from NOAA for July precip probabilities as of now. So some problems maybe in Texas and Western Canada, but outlining the Corn Belt normal to above normal rainfall. So putting the entire puzzle together, this is, I think, the issue for the corn market. In addition to meal and wheat supplies, is we assume a Brazilian corn crop of 140 million tons. We'll use USDA's number for U.S. corn production. Total combined exporter corn production in this calendar year will be, according to USDA, 612 million tons. That is up 1.5 billion bushels from last year. We think it could be 622 million tons, so up 1.9 billion bushels from last year. And so you can see that adding almost 2 billion bushels to supplies, and the corn market will be nuanced after harvest, but what does the cash market do when it sees all of this supplies between about August and November 1st? It's got to sort things out one way or another. Very simply put, clearing large supplies, getting rid of the stuff, and that probably happens through a pretty deflated cash corn market. So, if we get into the middle of July and the forecasts are pretty non-threatening, I think that we're kind of locked into this, record total exportable corn surplus in the world. So we got to put together initial targets, and most likely soybean meal is going to test, 2015, 2016's low. We got targets of about 255, 260 per ton basis spot. I think the forward markets come down to meet the spot market over time. So our target for, December is probably 260, 270. Again, margins seem to be pretty good, or at least milk to protein meal ratios are very, very high. We have no problem locking that in, but it is going to be a buyer's market. Corn probably targets what has been a pretty glaring open chart gap left after harvest of last year, and that is $3.95. We probably get to there, reassess what are the details of the July temperature forecast, what are early yield results from places like Louisiana, Mississippi. But I guess there is a scenario in that you kind of test last year's low of $3.60 per bushel. So in any sense, this downtrend has been established, and we've got to fill this gap, I think, before we make any sort of lasting recovery. So that's down still, 20, 25 cents per bushel. Dairy seasonal still intact, but we want to communicate that what's next for us is, again, there is upside in cheese and butter for all the reasons we mentioned. Maybe U.S. milk production growth slows in Q4. A lot of domestic demand, record exports. But think about Q1 2026 as we get into seasonal peaks in August, September, and October. Q1's always the time period to manage. Again, because the market's very myopic. You grow milk supplies, you grow butter, cheese supplies, so it just goes down. That's the beginning and end of what happens in Q1. But we can avoid this. So, target 50-cent recovery. Start to manage your risk in Q1 2026. As we start to add premium to the market, probably through the rest of summer. So that is kind of the recommendation we've got from Ag Resource, and that is it. There's a lot more going on. I guess in the next couple of weeks, we'll have to sort out what trade deals exist with China, weather, et cetera. But the dairy space looks pretty bright to us. If for no other reason, feed costs should be pretty low. So thank you for your time.
Yeah, I really appreciate this. Thank you for the deep dive and the bird's eye view, as obviously we can't always be the swallow that's swooping in there. You alluded to it, in a couple of weeks, we'll obviously touch base with you, see where things are at. But we have a couple minutes here. If we could just talk through some of those disruptors that are happening, they're a little unknowns. Obviously, weather, it's any man's guess. I think we covered that pretty good. We talked a little or noted on the trade, the tariffs, just some of those unknowns. But what are some other disruptors that are going on that can play into the what if game?
Yeah, I think the what if game is you don't see any real seasonal correction at all in cow herd size in the U.S. And so if you
Okay.
do have, improvement in yield, say you get back to, 0.5% yield growth year over year, on a monthly basis, I guess there's a scenario kind of like corn that we are growing U.S. milk production by 1.5, 1.8 billion pounds, at which point you kind of offset some of the export demand growth. So that's to be determined, but I guess just based on the last couple of months, we're doing really well at producing milk in the US. And so do you kind of cross a threshold that you're not oversupplied, but the markets don't have to do anything to sort of encourage retraction or anything. The market suddenly has to encourage this export demand, and the market stays cheap relative to other origins. So that would be the probably primary risk to the dairy space is just that the U.S. produces a lot more than we are currently, and there is evidence that the ingredients exist, just having a lot of cows to support that.
Mm-hmm. Bringing in some of the world's scope here, if you will, as far as some of the conflicts that are happening in various regions globally here, when you look at some of the oh goodness, how do I say this? Some of the fertilizer production that's happening. Obviously, they're in some of the areas that are being targeted right now. They're saying it's not really going to have a huge impact on the 2025 year, but if it doesn't settle down or kind of mitigate itself, come 26, would you expect more of a higher input cost in getting some of these crops obviously started and going, or is it a big or too far out?
I think that is a risk, unless things do settle down pretty significantly. Where fertilizer produced in bulk, we're not very friendly with at the moment. It's really none of those countries. So whether it's North Africa, the Middle East, China, Russia, I don't think there's a lot of downside fertilizer, and the risk is that you have places like in the Middle East that just kind of shut down production. So that's something to keep in mind and think about it. At least monitor it. I don't know how. I know forward contracting is pretty complicated with the fertilizer market, but it is certainly a risk to spring 2026, no doubt about it.
Okay. Before we leave you out for today, any last comments that you want to leave us, words of wisdoms to keep us going into this week or even into next week?
I think it's start to play with P&Ls a little bit. Again, I think if you're a row crop producer, we want to manage that risk, but I think it's going to be a pretty bright year. But pick your spots. What we do here is when we see value, you make an action. It's very simple, but I think we're getting to that point in milk feed ratios, or we're getting close to that. So start to think about that kind of stuff as we get into the middle of summer.
Absolutely. And again, Ben, thank you for joining us. Thank you for your insights. We cherish you and your team immensely. As you guys, folks, as our listeners go out for the rest of your week, quick reminder here, a little bit of housekeeping. I'll keep it short and sweet. Next week, the week of the 4th of July, we are going to take a rest. So farmers, enjoy your peace and quiet as much as you can. And I say that very open-ended because I live it, I breathe it too, and I respect what you're doing here. But we will reconvene the following week and we'll actually have another market update that following Thursday. So it'll feel like next week is here already. But also a true thank you to our sponsors, our partners that make not only the Dairy Signal possible, but programs that PDPW puts on throughout the calendar and academic year. Truly, sincerely, thank you. Thank you for partnering and walking with PDPW because in truth, they're really aligning with the fellow dairymen and helping us do what we do every day. So again, thank you. Thank you for helping making the Dairy Signal possible. Without further ado, have a great rest of your week. Thank you for tuning in. And by all means, share this, get these resources out there, however you mean. And if you have other topics you'd like to see covered, not only on the Dairy Signal, but in anything that PDPW or Professional Dairy Producers does, shoot them our way. Send them our way. We love ideas, brain dumps, all of the above. We're always open for new topics, new dialogues, and seeing what we can do for you. So without further ado, have a great rest of your week, everyone.